So good morning once again, everybody. You're welcome, Nika. So thank you very much. We are starting from where we stopped in the last class this morning. That's the last item we are supposed to touch under variance analysis. We've been able to treat all the variances, but this one, I believe you can see the screen, the market share and the market size variance is the only one we have not been able to treat. So I want us to quickly do that this morning, and then we move on. The last one we did was on planning and operational variance, operational variance and planning variance. So quickly we look at market share and market size variance. Further analysis of sales volume variance. Sales volume is a function of market share and market size. If the original budget derives budgeted sales volume from budgeted market share and budgeted market size, it should be possible to split the sales volume variance into a market share variance and the market size variance. The total size of the market is a factor that is largely outside the company's control, but is estimated at the start of the period. The market size variance is therefore a planning variance. You are welcome. The market size variance is a planning variance. Note that the ex post, like we said in the last class, budgeted market size is the actual size of the market. Don't forget the difference between the ex ante and ex post variance that we talked about. Ex ante is what you do, not knowing the circumstances that will happen in the year that the budget relates. Ex ante is what you do before the beginning of the year, not knowing what will happen. But ex post is what you do when you begin to know the actual circumstances that will happen during the year. So says there is what ex ante budget for sales, market size and market share, and there is ex post. So that is what will be affecting the sales volume variance under this size. So if the business had been better at the forecasting the market size, this is what they would have expected. The market share obtained by a company is under the influence of management through marketing activities. The market share variance is an operational variance. So we look at market size variance first. So what we are seeing is that sales volume variance will be split into market share and market size variance. So we want to look at market size variance. The market size variance is the effect on sales volume and so on contribution of profit. If the actual total size of the market is larger than expected, that is, if it is favorable, or smaller than expected, that is, if it is adverse. The total difference between the budgeted total market size and the actual total market size is calculated initially either in units of sales or sales revenue at standard selling prices. It is assumed that the company should achieve its budgeted market size. The market size variance of the company is therefore in units or in sales revenue at standard selling sales price. The difference in the total market size multiplied by the estimated market share. This is then converted into an amount of standard contribution or standard profit using the same method used to calculate the sales volume variance. So we talk about market share variance. A market share variance is calculated by taking the actual total market size, that is the ex post estimate of the market size, and comparing one, the expected sales volume if the budget market share had been achieved and the actual sales volume. This variance in sales units or in sales revenue is at standard sales price is converted into a contribution or profit variance using the same method using to calculate sales volume variance. So we take one example to calculate these two, the three variances, that is the total sales volume variance, the market size variance, and the market share variance. And this will be able to help us to see how the computation is done. So as usual, I'll take this one to Excel now, where we are going to be working with the information so as for us to be able to compute the variances. So let's have our exam here, the worksheet here. Let me put the question somewhere here, and then we solve it together. It's the last thing we are going to be doing on market share on variances. So I have it here. Zoom it so that you can see it very well. I'm sure you can see the question very well from your side. So he said, Bronco Nigeria Limited prepared a sales budget based on an estimated market size of 200,000 units and a budgeted market share of 25%. Standard contribution per unit is 40 naira. At the end of the year, it was estimated that the actual size of the market during the year had been 260,000 units. Actual sales in the year were 61,000 units. Required, calculate for the year A, the total sales volume variance, B, the market size variance, C, the market share variance. So quickly, let me do the solution here. The solution. You're welcome, Mr. David. Let me do the solution here so that we can. So the first thing we are going to work on Roman figure 1 is to calculate the sales volume variance. We want to know the sales volume variance. So let me put it here. Sales volume variance. So for sales volume variance, we know the formula. The formula is the contribution per unit, that is contribution per unit times, then open the bracket, actual sales volume minus standard sales volume. Don't forget, when we are dealing with sales, it is actual minus standard. But when we are dealing with costs, it is standard minus actual. It makes sense for us to know that when we budget to spend in terms of expense, when we budget to spend certain amount, and then we have a certain actual amount that we spend, we compare what we expect to spend to what we have spent. But when we are dealing with sales, which is an inflow of income, we try to compare actual to standard. For instance, if actual is more than standard, we say it is favorable because it's an inflow. But for cost, if actual is more than standard, we say it is adverse. So that's just the reverse. When you are dealing with sales, you start with actual minus standard. But when you are dealing with cost, it is standard minus actual. So based on the question, they said contribution per unit. So contribution per unit, this contribution per unit is how much? 40 naira. 40. Then says actual sales. I'm picking the information we need for this computation. Actual sales is 61,000 units. 61,000 units. What is the standard sales? Budgeted sales. Budgeted sales. We will calculate budgeted sales based on the information we have. They say market size is 200,000. This is how to calculate budgeted sales. That is 200,000 equals to 200,000 times what's the share of the market that they plan to have? 25% times 25%. So this is the budgeted sales. So let me put all of them in perspective so you can see exactly what we have done. These are the information we need to calculate sales volume. A contribution per unit Then the actual sales, like I've given us the formula, and the budgeted sales. Budgeted sales should be 25% of the market share. So just like if you are putting in the formula, the solution to sales volume variance, so we say sales volume variance therefore equals to, now be equals to 40 times, open a bracket, then 61,000 minus 50,000, close the bracket. So whatever solution this gives us is sales volume variance. So let's do it, equals 40 times, open a bracket, 61,000 minus 50,000, close the bracket. So sales volume variance is favorable, and it is what? 440,000. So I'll put it there, favorable. That's sales volume variance. Now what we have to do is to now split this sales volume variance to market size variance, which is from our figure 2. From our figure 2, we have market size variance. Market size variance. And so for market size variance, what we try to look at is what is the budgeted market size and what is the actual market size. Don't forget the formula for market size variance is contribution per unit, contribution per unit times, we open a bracket, actual market size, actual market size minus standard market size. Standard market size. That is the formula for market size variance. So what is contribution per unit? We already have the information here. So contribution per unit, so let me quickly just link that here. Contribution per unit is how much? Is 40 naira. We have it already. So what is the actual market size? Actual market size. Actual market size. The actual market size, according to the information, is 260,000. 260,000. And what is the budgeted market size? Budgeted market size. I think I can just drag this. Budgeted market size. Market size. Budgeted market size, according to the question, is 200,000. That's what they thought the market size would be, 200,000. So we want to look at the variance, the market size, market share variance. So now that we already have the formula and we have the information, we need to compute it. So it's just a matter of saying market size variance, market size variance equals 40 times, open a bracket, actual size minus budgeted size. Close the bracket. That's the formula. So if we are to do that, it's going to be what? 40 times, open a bracket. What's the actual market size? We have it here, 260,000 minus, what's the budgeted market size? 200,000. Close the bracket. 200,000. So if I have to calculate the figure, equals 40 times, open a bracket, 260,000 minus 200,000. I close the bracket. So we have the market size variance is 2.4 million. Let me check. Actual size 260, budgeted size 200. So yes, 2.4 million naira favorable. Market size variance 2.4 million naira favorable. So let's do the second one with the third variance, which is from figure 3 this time, is to look at the market share variance. Market share variance. Market share variance. Variance. For market share variance, the formula is contribution per unit. Contribution per unit. Contribution per unit. Yeah, open a bracket. Actual market share. Actual market share minus budgeted market share. Budgeted market share. So we need to get the information. What is the contribution per unit? We already have that. Yeah, same thing that we have in this place. Contribution per unit doesn't change. It's 40 naira per unit. What is the actual market share? Actual share. Actual share is how much we actually sold, which is actual sales. How much is that? 61,000. 61,000. So what is the budgeted market share? Budgeted market share. Budgeted share. Based on the share, budget is that we should have 25% of the actual market size, which is what? What is the actual market size? Actual market size is 260,000. We should a market size, yes. We want to add 25% of it. Therefore, budgeted market share will be 25% times 260,000. That's what we budget. So based on the budget, we should have a market share of 65,000. Whereas we have we sold actually 61,000. So if we have to now put the formula together, we say market share variance is now equals, then we have 40 times, open the bracket, equals 40, open the bracket, the actual, which is how much? 61,000 minus the budget, which is 65,000. Then we close the bracket. That's going to be the formula. So what is the market share variance? Equals to 40 times, open the bracket, 61,000 minus 65,000. Close the bracket. So we have adverse of how much? There's adverse of 160. Sorry, there's something here. Let me check. 260,000, 200,000. Would I put the figure right? 260,000, 200,000 times 40. Yes, it's right. 61,000, 260, 200. I'm checking. This is adverse. Adverse want to check if this is 200,000, 260,000. We have 40. That's 60,000 difference. Market size 200,000. Actual market size then there is 260,000. I'll multiply that by 40. Well, that will be 60,000 times 40 is 2.4 million. And this one, 60,000. Sorry, I'm trying to check if there is any computational error. $240, 2.4, 440. The difference between this one is just 4,000. So at the end of it, this is the actual market size, and this budgeted market size. So what is the actual variance that we are supposed to get? I'm trying to look at, because the addition of the two, like I said, will give us what we call market share variance. As my sales volume variance, the two added together should give us sales volume. 260, 200 will give us 60,000. Okay, I think, yeah. So the variance that we are actually to use here, 260, 200. When we deduct these two, 260 minus 200, we have 60,000. Our own business, the company's own business is 25% of it. That's what we use to calculate the variance. So we should have looked for 25% of this, because that is that's the basis upon which their sales is computed. This is the actual difference in the market. The actual market variance is 60. That is variance in size is 60. But the business of the company is just to deal with 25% of it. That's what we are going to be using in their own. 25% of it is what will be affecting the company, not the entire 60,000 difference. So 25% of, it was 25% of 60,000. So the variance will be computed based on 15,000, not 60,000. So the formula here should have been that, okay, I will restate the formula 40,000 into brackets this, then I'll now say times 25% times 25%. So whatever we get will be multiplied by 25%. So if I say this times 25% now, times 25%, we having 600,000 years. Because don't forget, the only lot of the company in the entire market size is 25%. So if we look at the difference in the company, in the size of the market as a whole, and we are able to arrive at it, which is what? Favorable. Size was budgeted to be 200, but eventually it was 260. Favorable. The lot of the company is just 25% of the variance in the market. So this is the entire variance in the market, 260 minus 200. But multiply by 25%, then multiply by the variable, the contribution per unit, we have 600,000. So if we had these two, which is now sales volume variance, sales volume variance is now to do what? We want to calculate our sales volume variance. We take the market share variance, the market size variance, which is how much? Market size variance, which is the amount is this, favorable, and then the market share variance, which is this amount. It's also this one is adverse. If we had the two together, you know that we'll be having our, let me remove negative from this one. Don't forget, like I said, negative, we don't use negative in variance. We either call it adverse or favorable. So Um, so when we do the 2 plus this minus this, we have a sales volume variance which is favorable. So that's how to calculate sales volume variance splitted to market share and market size variance. I believe we understand that already. So that's the end on variances. Please watch the video and make sure you get it. Quickly, we move to a new topic now, and of course, this video will be part of the new topic because we are doing it together on the same day. But by the time you watch the new topic, you'll be seeing what we have done. The sales volume variance splitted to market size variance and market share variance. So that's about that. So I'll be taking us to our new sheet where we'll be working on. We are starting a new topic afresh this morning, and the topic is on transfer pricing. Transfer pricing. That's what we are starting afresh this morning. Don't forget there's a topic after this according to the syllabus. It's a lot of reading which I want you to read on performance measurement. And of course, I'll still touch the area where there's a little competition there, where we just try to look at the profitability ratio, the liquidity ratio, all of those things. I will touch on it. But I want to make sure I focus on the ones that has to do with recalculations first and complex principles, so that towards the end, we can just touch on those ones briefly. The areas where there can be complex calculations, I want us to invest our time on it. Those aspects that requires only reading, I expect that we'll be able to do the readings on our own. But if you now need help on anyone, you can refer to us. The syllabus is wide. We must be able to accomplish something substantial. And so we'll be able to deal with any question on the ones that are actually so substantial. So this morning we are starting with transfer pricing. Introduction. When a company is divisionalized, it has a divisionalized structure. That is, you have different divisions in a company. Some of the divisions might supply goods or services to other divisions in the same company. One division sells the goods or service. This will be referred to as the selling division. Another division buys the goods or services. This will be referred to as the buying division. So we have a division that produces something like a components that is needed for another division to perform its work. And those divisions are the organization is structured according to divisions. So each of those divisions have functions that they perform. They can either be cost centers, in which case they don't expect them to make profit. They just begin to incur costs. We'll still be looking at those definitions for cost centers, investment centers. Investment centers will be expected to incur costs and also generate revenue. Because when we are measuring the performance of the organization as a whole, we have to look at the performance of the various divisions of the organizations to see how effective the managers in charge of those divisions are performing their duties. So we are looking at now a division produces components, and then another division, which is likely to be an investment center. So we are looking at them as if they are investment centers. That is, they have to incur their own costs and generate their own revenue, and so make profit for the company as a whole. So for accounting purposes, this internal transfer of goods and services are given a value. Transfers will be recorded at cost. However, when the selling division is a profit center or an investment center, it will expect to make some profit on sale. So let's look at transfer price. A transfer price is the price at which goods or services are sold by one division within a company to another division in the same company. Internal sales are referred to as transfers. That is, sales from one division to another, they call them transfer. So the internal selling and the buying price is what we call the transfer price. When goods are sold or transferred by one division to another, the sales for one division is matched by the purchase by the other division, and the total profit of the company as a whole is not affected. It is an internal transaction within the company, and a company cannot make a profit from internal transfer. You cannot move something from your right hand and put it in your left hand and be expecting to account for profit, regardless of what price you exchange it. So the company as a whole does not benefit from the transfer. So the transfer price and the benefits coming from it is actually to each division, and it is to measure the performance and efficiency of each divisional manager to be able to see how effectively they run their divisions. A decision has to be made about what transfer price should be. A transfer price may be one, the cost of the item to the selling division, or a price that is higher than the cost to the selling division, which may be cost plus a profit margin or related to the external market price of the item. What we are trying to say is that if the division, like I said earlier, is a cost center, that is, the company is not expecting the division to generate profit, their income that will bring in profit for the company as a whole, but they are just cost centers. You can use cost of the item to determine what the transfer price will be. But if it is an investment center, that's where the complication under this topic comes in. If it's an investment center and the company is expected to make its own profit, the division is expected to make its own profit, which shall be used to measure the efficiency of the divisional managers of that division, then a complication comes into determining what a transfer price should be. So we look at the possible methods we use in transfer pricing. There is the marginal cost, there is full cost, there is cost plus, and there is the market price. So we'll be taking one example, and under the one example, we'll be looking at the different types of method that can be used in determining the transfer price. So I'm taking this example from here, and then I'm going to take it to the worksheet where we shall begin to work on the transfer price using the different methods and to see how a conclusion is reached about how much the transfer price should be. I'm trying to cut this question now and take it to our worksheet to see how transfer price should be. Just 1 minute. So take us to our worksheet now, where we will be dealing with this issue, transfer price. So just 1 moment again, take us to our worksheet. So we want to work on transfer price here. So I want to bring the question here for us to see. How is it? Just 1 minute. Okay. So here's the question. We'll be using it for the different methods of transfer prices. So the first one, let's have the solution here. Solution. The first method we are looking at is the marginal cost method. The marginal cost method of determining what the transfer price should be. In this method, we are trying to say that the price at which the items produced in one division is transferred to the other is just the marginal cost. The marginal cost. Good morning, madam. Welcome. It's just the marginal cost that we are going to be looking at, the marginal cost to the selling division. So we said an entity has two divisions, division A and division B. Division A makes a component X, which is transferred to division B. Division B uses component X to make an end product Y. Details of budgeted annual sales and costs in each division are as follows. Division A, the unit produces 1,000. Division B also produce 1,000 units. Then the sales of final products, that is, Division B is the one selling the final product out. Now, don't forget product Y is the end product, while product S is a component. We look at the cost of production. The variable cost of production is there, 70,000 for all the 1,000 units produced by Division A, and that's for variable cost. And there is additional variable cost in Division B, that is after collecting the component from Division A, Division B also spends 30,000 naira, which is 30 naira per unit, on the components to make it a final product Y. Then there is fixed cost for each division, 80,000, 90,000 respectively. The total cost is 150,000 and 120,000 Division B. What is the budgeted annual profit for each division if the unit of component X are transferred to from Division A to Division B at marginal cost? So let's look at it at marginal cost first. So what we're going to be doing is to first have the divisions, the various divisions. We have Division A, okay, let me just put it over figure 1. Let's say we are dealing with marginal cost here. Transfer price at marginal cost. Transfer price at marginal cost. Transfer price at marginal cost is what we want to deal with here. So we have Division A, then we have Division B, then we'll look at the company as a whole, the company as a whole. So let me just wrap this text so that we can have the company as a whole. So we'll be looking at what their performances are. So the first thing we look at is the unit produced. The unit produced in Division A is 1,000 based on the we are just extracting information from this question. 1,000. Division B is also 1,000. But the output of the unit is also the same thing, is 1,000. Don't forget, end product is product Y. This is component X produced by Division A. Okay, let me just try to put that in so that we'll be able to see the difference when we are able to work out the difference. So Division A produces component X, while Division Y produces product Y, end product Y. So if we agree that this is what they are doing, then don't forget that it is the end product Y that the entire company is sending out. The end product Y is what the entire company is sending out. So when we are talking about volume under the context of the entire company, we are looking at the end product Y. That is the volume of sales that the company is having. That's why we have these figures here, and they have the same figure. Component X produces 1,000, end product Y produces 1,000, and the entire company sells their end product 1,000 out. So the first thing we look at is the external sales. So we are going to have our Naira signs here. Let's have the Naira signs here. We want to talk about monetary computation now. Let me just put this ones here like this. We want to talk about the monetary value computation now. So we let's look at the external sales. The external sales. That is the item sold outside. Under this circumstance, what we have is that this company is selling everything internally for the component. So external sales here is 0 for this division A. But external sales here, based on the information, sales of final product is 350,000. Therefore, external sales to the company as a whole is what equals to the sales made of the final product. So we do the external sales and then we then move on. So the next one will be to determine the internal sales. Internal sales. And for internal sales, we know that is only component X that is sold internally from division A to division B. What is the value of internal sales? Internal sales is what we are determining now using what? The marginal cost. The marginal cost. So what's the formula for our internal sales? Since we are dealing with marginal cost, don't forget marginal cost is just variable cost. It's going to be what? The variable cost that is BC per unit times the quantity sold. If you look at it, the BC per unit times the quantity sold. If you look at it from this question, they didn't tell us the unit per unit. They just told us that the cost is 70,000. So if 1,000 items are produced at 70,000, the variable cost per unit is 70 naira. So 70 times 1,000 is what gives us 70,000. So we can just put our 70,000 here. That is the variable cost per unit. Since it is just the marginal cost they use as the transfer price. They use the marginal cost as the transfer price. Then we can do the total sales. And don't forget, a company cannot be recognizing that cost under its own this place is an internal sales. They generate the sales here, and so that one also will be here. So here there is no internal sales. So the company cannot be having a double sales. You can't be accounting for sales made internally in your revenue as a company. So therefore, internal sales is 0 for the company. Do you get it? You can't be telling yourself that you make sales internally. This is the final account of the company as a whole on product Y, on end product Y. So you can't be accounting for any internal sales made to yourself. You can't make profit internally. So therefore, we do the total sales. The total sales for each division. The total sales here is 70,000. Total sales here is 350,000. And so total sales here is also 350,000. So I will put this one in bold form so that you can know that it's the summary of the performance of the divisions that we have in this place. So if this is the total sales, then we deal with what? We deal with what we call the cost now, to know how much it costs to actually make the sales. So we can deal with the cost of production here. Cost of production. The cost of production. So the first one is the variable cost. The variable cost. Just as we are given in the question. The variable cost for division A, division A, their variable cost is 70,000. For division B, the variable cost. Okay, for the variable cost, first we look at the internal purchase. Sorry, we have to split it to internal purchase. Let me move this one here. Internal purchase. Internal purchase. That is the cost incurred per item purchased from a department. Division A did not do any internal purchase. It was Division B that did internal purchase. And how much did we say they purchased? What they purchased? They purchased that they amount that the Division B sells, Division A sells it at 70,000. That is their internal purchase. That is, we are looking at transfer price at the marginal cost. That is the cost, which is what? Variable cost. That's internal purchase. So that one is here. For internal purchase, the company will not account for an expense. Don't forget, the company will not account for. You can't take something from your right hand and put it in your left hand and still be considering that it's an expense. It is still you who hold the two things. So anything internal, it is not accounted for under company. Look at it. Internal sales, no account for the company. Internal purchase, which is a variable cost for division D, will not be accounted for under the company. The variable cost, yes, then there's a variable cost for division D, which is 30,000 naira. You can see 30,000 naira. So it is this one that the company can account for as an expense. That is the sum of these two. It's a cost to the company. It's a variable cost to the company, 100,000. Then we have fixed cost. The fixed cost for division A is 80,000. For division B is how much? Is 90,000. Therefore, if we add the fixed cost together, if I drag the formula here down, the addition of these two is the fixed cost. So we can then decide on their total cost. The total cost for each session. This is total cost, and this is the total cost for the company as a whole. Total cost for the company. That is cost incurred by each division is added together as the company cost as a whole. So then we can now talk about profit. The profit. Division A, to arrive at profit, we say what? Sales minus total cost. So we have division A has a loss of 80,000. Division B has a profit of 60,000, and the company as a whole has a profit of 80,000. You can see now division A has a loss that is equivalent to its fixed cost because it has been made to sell the items it produced at its variable cost. So that is the variable cost, the marginal cost method. So this is how it's going to be presented for the marginal cost method. The marginal cost method will be presented like this. The sales from the unit produced, you can see there. Then we talked about the external sales made. It is only this company that made external sales. Then internal sales, it is only component A that is sold internally. The company cannot account for it as a whole. Then we talked about the cost of production for each company. The variable cost, the internal purchase cost will be accounted for. Don't forget, it's part of cost of production for division B because it's a variable cost for each component purchased from division A. And then the further variable cost incurred, and so you can see how the account is done for each company and how they should be accounted for. So the challenge with this system is that division A will be seen as reporting loss. This will not be fair on the manager of division A, except the company does not treat division A as an investment or profit center. Profit centers are just to make profit on everything they do. For investment centers, we must do investment appraisal. That is, we must be able to calculate the cost and then the revenue, look at the differences between them so as we can measure our performance efficiently. So when we use the marginal cost to calculate the profit of the company, of the division that is actually making the sales, the internal sales, will be affected. They will be having loss that is equivalent to their fixed cost. So the second method we want to work on, we want to go through, is the full cost. Let me quickly show us there are 4 methods I'll take us to our Excel now. So we can see the four methods that can be used in measuring these. The four methods that we are told that can be used in measuring this, we can see it there in the question. The first one is the marginal cost. That's the one we did now. So we want to work with the full cost method now, the full cost method, and see how that is done. So let's go back to our worksheet where we shall be having that done. So we want to look at the full cost method here. Transfer price at full cost. Transfer price. Transfer price at full cost. Transfer price at full cost. If that is the method that is used by the company, we need to know how the computation is done. So we are going to be having the same format that we have in preparing these. But what will be different is in the figures, the computation. So let me quickly do some linking so we can just save time. The components, then this, then this. We can then have this like this. The various divisions, the units, and then the naira sign. I just try to replicate what I have up there so that we save time of having to compute it one by one again. So here is the unit produced. We have that here. And then we want to have external sales now, just like we have it here, external sales. The external sales is this division A does not make any sales externally. It was division B that made external sales, which is 350,000. So therefore, the external sales to the company as a whole is the amount generated by division B, since it's the one making the end product. So we put that in perspective. Then we go on to internal sales. Internal sales. For the internal sales, what we are told, there will be a formula for the internal sales. The formula for internal sales is that the full cost per unit, which is how much, look at it in the question. The total cost of the product to the total cost to division A is 150, and the items produced are 1,000. Therefore, full cost per unit is 150 naira. So the formula for internal sales is going to be what? The 150,000. They are looking at fixed cost plus variable cost times the 1,000 units sold. 50 times the 1,000 units sold. So therefore, the external sales for this company is what? Is 150,000. 150,000. That is it. Don't forget, like internal sales, sorry. Don't forget, this one does not have any internal sales, and the company as a whole can also not account for internal sales. You can't be counting as a cost. It says that you made transfers that you made from one company to the other within your organization. No, you can't take something from your right hand and put it on your left hand and be accounting for it as an expense. So then we have their total sales can be accounted for here. So the total sales can be accounted for here, which is the sales for the company for each of them. It can be seen as we have done it. The sales for division A and the one for division B is there, and the total to the company as a whole is also here. So then we can now do cost of production, the cost of producing, sorry, I have to put it in capital letter. Cost of production, the cost of production. So there is what external, there is internal transfer. Internal transfer, that is the one that we sold inside. Internal transfer. Internal transfer. So here is 0. This one does not buy anything internally, but division B bought something internally. The amount that division A sold it to it is what it bought it internally. And so the company also cannot account for internal transfer, because you can't take something from your right hand, put it in your left hand, and account for it as though it is an expense. So any internal transactions will not be accounted for in the company. But we talk about very other cost, which is variable cost. Variable cost. For variable cost, these ones, based on the question, incurred how much? 70,000 naira, 70,000. And this one incurs how much? 30,000, based on the question. You can see it in the question. 30,000, 30,000. And then the total of the two is what the company must account for, which is 70 plus 30 is the total cost to the company. The company can account for it here, which is how much? 100,000 naira. Then we talk about their fixed cost. Fixed cost. The fixed cost to each of the company. This one's incurred 80,000. This one incurred 90,000. So the total of it is what the company will account for as well, which is how much? 170,000. So total variable cost to the company is 100,000. Total fixed cost to the company is 170,000 naira. So if we have this accounted for like this, we can then account for their total cost. The total cost is here for each division and for the company as a whole. So once that is done, we can then calculate the profit for each division and for the company as a whole. So the profit can be calculated there. Profit, and if you look at it, for each division it's going to be what? Sales minus cost. Minus cost. And so there is 0 here, and then if you take it down, you can see the profit of the company as a whole is 80,000, just as before. And division B is the one who actually made that profit, because the full cost of production in division A is what they use in transferring the cost to division B. So that is how this is done and accounted for. But sometimes we talk about capacity of each division. What if actual sales quantity is more than the budgeted quantity? Let me take us back to the slide where we actually talked about this, so that we can see exactly what situation I'm talking about now. What if the budget is less than actual? So we talk about the marginal cost. The explanation for marginal cost is that the actual sales are high. When the actual sales are higher than the budget, we'll do it for both marginal cost and the full cost. We do it for both marginal cost and the full cost. So the same situation occurs if actual output and sales differ from budget. If production sales are 1,100 units, the profit of division B will rise, but division A will make a loss equal to its fixed cost. The total company profit increased by the same amount of the increase in profit of division B. But what is reported profit? That's exactly what we should calculate. If we should calculate this, since it is marginal cost, It is the marginal cost that it will be accounted for. But let's look at it under full cost. For full cost, if the actual production is 1,000 unit, 1,100 unit, let's look at what the performance of each division will be. So I'll go back to where we are doing our computation, and then we just look at the actual performance being different from the budgeted performance for the period. So let's do this transfer at full cost. I'll do that one here as a Roman figure 3. And it's going to be transfer price at full cost, transfer price at full cost when actual sales, when actual production is more than the budget. When actual production is more than the budget, what is the transfer price? So let me put that there. Okay. I want to write it in there. When actual is more than the budget, what is going to be the price, the transfer price going to look like when that situation is what we have? Let me see if I can take this up a little. Just a minute. I want to try and move this up where the format looks the same. So when the transfer price at full cost, when actual production is more than the budget. So we have our headings as usual. Just going to start typing them fresh and wrap this. So we have the divisions, the various divisions here. And so we have the unit produced this time. Unit produced. We are saying that unit produced is more. So unit produced now, assume it is 10% more, which is 1,100. 1,100, and this one also 1,100. And the one for a company as 1,100. So we are looking at first the external sales. So let's copy the unit sign. The external sales first. The external sales will now be how much? Don't forget what the sales price is. If we look at this compared to when it was 1,000 naira sold, you know that the sales price is 350,000. So sales is going to be about 350,000 times 1,100 under this circumstance. So what we are going to be having is going to be, we are looking at the sales, external sales will be, the formula will be 350 times 1100 in terms of quantity. Don't forget, we just assume that the quantity sold is more. And if 350,000 is a sales for 1,000 units, then 350,000, okay, what's this? So, external sales, none here. There's no external sales from division A. For division B, will now be the one selling 350 times 1,100. So it's going to be having this as the external sales, and the company, of course, we have the same as the revenue generated from external sales. Then we look at internal sales, internal sales. Internal sales. So it is this company that sold internally. And what is going to be the formula for internal sales? If it costs for full cost, you can see it's 150,000 for one. For full cost, it's 150,000 pounds. So we're going to be having 150 times the 1,100. It's 150 naira for one for full cost. So that's going to be the value of internal sales. So equals to 150 times 1100. And so we have, this is the value of internal sales for division A. And don't forget, like I said, that the company cannot account for internal sales because it is still within the system. It is not an expense. It's not an income that the company can recognize. So we can then look at the total sales, of course, and that is just going to be the addition of this item sold. So sorry, just so that is it for internal sales. For internal sales, so for the total sales. So let's look at cost of production. Cost production. Sorry. Cost of production. For cost of production, we are going to be having internal transfer. Internal transfer. For internal transfer, we know that it is just Division B that bought something internally, and Division B bought it at the amount that Division A sold it. So for internal transfer, the company cannot account for it. It is still within the system. You can't account for sales made within your system. So we have external. We now have variable cost. Variable cost. The variable cost incurred by each department. This one is still with the variable cost will now be how much? 70,000 for 1,000 units. So it means 1,100 units. Going to be 70 times 1100. Don't forget the variable cost is going to be based on the quantity of the variable cost. So okay, for this place is 70,000 times 11 equals to 70 naira times 1100. And for this place, okay, let me just put the concept 70 slash 30. Don't forget, this is their home. They incurred additional 30 naira on each. That's why they're having 30,000. If it is 1,000, the variable cost is 30,000. Then there's addition. That's 30 naira times 1,100 equals to 30 times 1100. That's the variable cost here. So total variable cost for the company is the addition of the variable cost for the two divisions. The addition of the variable cost for the two divisions. Then we have fixed cost. Don't forget, fixed cost does not vary. It is usually fixed regardless of the quantity produced. At least in the short run, fixed cost is always fixed regardless of the quantity produced. So fixed cost, and for fixed cost, it still remains 80,000 here, and here 90,000. So the total fixed cost is the addition of the fixed cost for the two divisions. You can see that. Then we can now do with our total, the total cost by adding all the costs incurred for each division together, and then we have the cost incurred for the company as a whole. What's this? Yes, that's correct. The cost for the company as a whole. So this is going to be the cost. Yes, internal expense cannot be accounted for here. So that's it. That's the cost to the company as a whole. So you can now look at the profit, the profit, the profit. So this one is their sales minus their total cost. This one has 8,000 now. Then the company as a whole has 105. You can now see how the sales, the difference is the profit is shared now. And the reason why this division A has a profit now is because he was able to produce more than budgeted. The actual production is more than the budgeted production. That is the favorable advantage that gives division A some income at the end of the year. And then the total is 105 for the company. This one has 97. This one has 8. That is how the this one is accounted for when the activity, when the actual, don't forget we just finished variance. When the actual is more than the budget, we are going to have this experience for each division under full cost. Under full cost. The difference between here and here and why there is additional profit in each division is because the amounts they actually produce is more than what they budgeted. So fixed cost does not change, but the variable costs are the only ones who change, and the additional income they were able to generate is based on their ability to produce more than budgeted. So what we'll be doing now is to look at other the other. Let me see if I can move this. No, okay, let's move it. We have done the first one, marginal cost. If you do the marginal cost for different activities too, this one will still not have any profit because the amount that it will be accounting for will be based on its variable cost, that is his own sales. His fixed cost will still be his own loss for the period. Nothing will change. But it changes there because fixed cost does not change, but variable revenue change because full cost, which is 150, is what it used to sell. That's why it has more income here than expected. So let's look at the third method that can be used to calculate this. The third method that can be used to calculate this based on the information we have from the question. The third method, don't forget we said the first one is marginal cost, the second one is full cost, the third one is cost plus. So let's see an example for cost plus. And so transfer pricing at cost plus. For the purpose of performance measurement and performance evaluation in a company with profit centers or investment centers, it is appropriate that 1. The selling division should earn some profit or return on its transfer sales to other divisions, and 2. The buying division should pay a fair transfer price for the goods or services that it buys from other divisions. One way of arranging for each division to make a profit on transfer is to set the transfer price at an amount above cost to provide the selling division with a profit margin. However, the transfer price should not be so high that the buying division makes a loss on the items it obtains from the selling division. So we have this. Using the previous example, what is the budgeted annual profit for each division if the units of component Y are transferred from division A? Okay, sorry, it's component S that this should have been S. The component you are looking at is S. From division A to division B at full cost plus 20%. Full cost plus 20%. So what we are going to be taking is this information. That's the only additional information we'll be putting in that example. That is, division A is transferring the component it has prepared, it has produced to division B at full cost plus 20%. So let's go to the worksheet and do that on full cost plus. Full cost plus. So let's have that here. That will be Roman figure 4 IB. So transfer price at full cost plus. Transfer price at full cost plus. So, and then we having all the headings as appropriate. So let's have it here. The components, the products, and then the end products. And then we can have that for this, and then this. So I can wrap it up, then have it done. So I'm just expanding a little for each. Okay, that's done. So I'm bolding this. So we look at the units produced and how that that is done. To have the same thing as this place. Okay. This I should be. So we're going to be looking at the unit produced. The unit produced, the external sales. This is the unit produced here. The unit produced, we assume it is still 1,000. We'll be looking at the effect when the unit is or that may not even be necessary. So unit produced and sold, you can see it's 1,000. So let's look at external sales. External. The arrangement is that you account for what is made externally. In this, we are not told that division A sold anything externally, so it is 0. But for division B, its own external sales will still be what? The 350,000. Don't forget we are still accounting for 1,000 units. 350 naira times 1,000. So 350,000. And so the income to the entire company is the same as how much they were able to sell externally we sell the product while externally. So we can look at internal transfer. Internal transfer. The internal transfer now is what we must work out a formula for. And what is the formula? We are told that the sales is made at what? Full cost plus 20%. 20% of full cost is what they made. So how much is that? So let's just put it in the formula. It's going to be, that is, the full cost is 150,000, 150 plus, so no, you can say 150 times open a bracket 1.2. I don't know if you get the whole idea of 1.2. That is 100%, which is 100 divided by 100, 1. 100 plus 20% is 120%. So 120 divided by 100 will give us 1.2. We are trying to adjust the price to 1.2, then multiply by the quantity times 1,000. Times 1,000. That is going to be the full cost plus, that is the amount that the company, the internal sales will be accounted for. So equals to 150, which is full cost, times 1.2 times the quantity 1,000. So it means they are going to sell it at what? 180,000. That's what they are going to make their sales. 180,000. Their sales will be 180,000. So, but they can't account for, there's no internal transfer here, and the company also cannot account for internal transfer. The company cannot account for internal transfer. You can't generate income from within your own company. So then we look at the total sales, the total for each of the division. Then the sales is here accounted for as follows. The total sales for the company as a whole is accounted for, and the one for each division can also be accounted for. Then we look at cost of production. Cost of production. What's the cost of production for each division? Production. The cost of production for each division is also accounted for, looking at the cost they actually incurred. So we look at internal transfer first. Internal transfer. Internal transfer. And then that will be, since this one did not buy anything internally, 0. It is this one that bought at the amount that this one sold it, 180. The company cannot account for internal expense because it is still within the system. So that's about that. Then we go to their other cost, the variable cost. Variable cost. And for the variable cost for each company, this one has 70,000, still 70,000, 70,000. And then this one has 30,000. So this company as a whole has a variable cost of 100,000 because the costs are incurred at each department. So the company has, so we have a fixed cost. The fixed cost. This one is 80,000. 30,000. This one is 90,000. 90,000. So the company as a whole has a fixed cost equivalent to the total fixed cost incurred by the two divisions. So then we can account for their total cost for each company, or each division, sorry, and for the company as a whole. We have a total cost of this amount. Total cost of this amount. So total income, total cost, and then we can talk about profit. Profit for each division. So it's going to be sales minus cost. So this one has 30,000, and then if we drag it down, you can see the profit for each division and the one for the company as a whole. The one for the company is the aggregate of the profit for each division is 80,000. So when there is a cost plus, the percentage is the margin, because they want to measure the performance of each division because they are both either profit center or investment center. Therefore, they allow division A to do its own business at a percentage. But all of these are arbitrary. Arbitrary because it might just be the political ideology within the organization to just have an arbitrary percentage as profit for each. They have not actually allowed for each division to have autonomy. Autonomy meaning that they should be able to decide their own prices based on the economic situations within the geographical locations where they are doing their business. So let's go further to our slide to get some information about this old ideology. So we said that we have been able to do this now using the cost plus. So we said the cost plus transfer price succeeds in sharing the total company profit between the two divisions. However, the transfer price is arbitrary because the profit margin of 20% is arbitrary. If the transfer price lacks commercial reality, the reported profit of each division are not satisfactory measure of performance because it is politically influenced. That's it. So we say transfer pricing at market price. It will be more realistic to set the transfer price at or close to a market price for the item transferred. But this is only possible if an external market exists for the item. We're looking at, okay, this component that is being produced by division A, is it available in the external market? So that division B can decide to whether to buy from division A or to buy from external market. That will be more realistic than just to decide, okay, do it at marginal cost, do it at full cost, or do it at full cost plus certain percentage. The more realistic performance measurement will be done when there is an external market. So we look at the question, it's a question that talks about an external market, and how computation should be done. So I'm going to take this question and we work on it, looking at it when an external market exists for the product under consideration. So let me take this to where we are going to work with it. When there's an external market, how will the profit reported by the company be accounted for? So I'm coming. I want to take us to Excel. They took light, but if my battery wants to go off, I will definitely try to switch on Gen because we must complete this. At this exam date is drawing close and you can't afford to take chances. So I want to put let me put this question here. The one we want to work on now. So this is the question we want to work on now. When there is an external market exists, how is the transfer price supposed to be made? An entity has two divisions, division G and division K. Division G makes a component P, which is transferred to division K. Division K uses component P to make end product Q. Division G budgets to sell one half of its output to division K and the other half to external customers. The market price for component P is 160 naira per unit. It has been agreed that transfers between the two divisions should be at market price. Details of budgeted annual sales and cost in each division are as follows. Units produced and sold. Of course, division G, which is the one doing the component, produced 2,000 units. Don't forget they said the decision of the company is that half of what is produced in G is sold outside, while the other half is sold internally. Details of budgeted annual sales and cost in each divisions are as follows. So we have all of that. 2,000 sales of final products is now there, accounted for that way. Then cost of production, variable cost, fixed cost is there. What is the budgeted annual profit for each division if the units of component Y are transferred from division G to division K? So we want to look at Roman figure 3 now. We are working with transfer at market price. Transfer as market price. So transfer price at market price. Transfer price at market price. So we want to look at how should this be accounted for. We'll still be using a format that we used previously, which will be accounting for. So let me just bring the information here. It's going to be the same pro forma format. It's important that we know how this format is done so that in exam we'll be able to present our answer in a way that will inspire our examiner. So I'm just trying to bring this. So what is this one? Will be division G this time. So let me first put this. So the component we are talking about is called component P under this circumstance. The end product we're talking about is product Q, end product Q under this question. So end product Q here also is where the company starts. And so we have division G, which is the one producing. Division K is the one actually doing the final product. And the quantity produced, unit produced by division. Division G is 2,000. Division K is 1,000. So we are looking at the units sold outside. Here we are just going to be having it optional. We have 1,000 sold outside and 1,000/1,000 sold inside. The component sold outside is an income to the company, and the one sold inside is the only one that is not an income to the company. The circumstance here is different from the ones we've been doing before. So let's have a naira sign accounting for it in monetary value. Monetary value. And so we can now talk about external sales. External sales. For external sales, half of what this company produced, this business produced, sold externally. So there is an income for the company as a whole from external sales of components. And 1,000 is the quantity, whereas the cost, the market price for the component is 160,000. It's 160. So 160 times 1,000. 160 times 1,000 is the external sales that we accounted for the components sold externally. And the external sales here is still what? 350,000. 350,000. So there is a total external sales for the company. Unlike before, we'll be adding the one sold externally. Don't forget, it's only the one sold externally we are accounting for it. We are talking about external sales. We are not going to be accounting for the ones sold internally to this division under external sales for the company as a whole. Don't forget that. So we now talk about the internal sales. The internal sales also, we are told that what is the better annual profit for each division if component Y are transferred from division G to K at market price. Definitely that internal sales also at market price, which will be what? The same 160. So 160 times 1,000. That's the formula for the internal sales as well. 160 times 1,000. So that will be how much? The same 160,000 that we have here. But there is no account for internal sales here. There's no account for internal sales for the company as well. Don't forget, the company cannot account for sales made within its divisions. So we can now do our total sales account for our total sales. Then we have the total sales done like this. We can account for our total sales like this. So we talk about cost of production, cost of production. So we talk about internal transfer, that is the cost incurred internal transfer. And for internal transfer, we will be looking at this one did not buy anything internally. The only one that bought internally is this, and he bought at how much this one sold it, 160. And the company cannot account for internal exchange as an expense. So the company will say it is zero. They don't account for internal exchange within the company as an expense. They'll talk about the variable cost. So what's the variable cost to this company? This one has 140,000. Why this one has 30,000? So the total for the company is the sum for both divisions as their cost. Then we have the fixed cost. The one for this is 80,000. The one for this is 90,000. So the total fixed cost is the addition of the cost for both companies, which is what? 170,000. Then we can talk about the total cost for each division. And then for the company as a whole, that is accounted for like this. For the company as a whole. So we have the total cost like this. Then what is the profit? Profit is sales minus sales sorry, sales minus the cost. So this is the profit for each division and for the company as a whole. That is how it's accounted for. Now, don't forget that they just have a a a yardstick for determining price externally. They still have not allowed each division to do what they like. Because division G that is producing 2,000 might decide that I don't want to sell anything internally. I want to make more profit. I don't want it to look like I'm not performing. Because when the time comes, they are now trying to do performance analysis to know which manager to be promoted and which one is doing better. I won't be able, there's no yardstick for measuring the performance because the company at the head office is the one deciding the quantity I should sell internally, the quantity I should sell externally. What if I decide to sell all my product externally? And division B to or division K that is buying to can decide, but must I buy from division P? What if there's a better market outside that the price is cheaper? We have been able to answer this question. Let's go back to our slide and look at other circumstances that may cause variation to exist within the divisions and what can actually motivate each. Okay. How many minutes do we have more? 18. And my battery is okay. Let me see if we can just do like 10 before the system shut down. We will not be able to put on gen. We will continue from there on Thursday because the time is not. We just have limited time. So my battery is showing 19%. Let me see how many minutes that can carry me. Then we'll shut down. Then on Thursday we'll start from there. So I'm going to back to our here. So I've been able to treat this example. So we are saying because transfers at market price, it can be argued that the profit of each division is a reasonable measure of their financial performance. So first, let's look at the objective of transfer pricing. Transfer prices are decided by management. When authority is delegated to divisional managers, the managers of the selling and buying division should be given the authority to negotiate and agree the transfer prices for any goods or services sold by one division to another. They should be able to allow them to decide to have the autonomy of that decision. The objective of transfer pricing should be to make it possible for divisionalization to operate successfully within a company and one, give autonomy, that is freedom to make decisions to the managers of the profit centers or investment centers. And two, enable the company to measure the performance of each division in a fair way, like I said earlier. Let's look at what we mean by divisional autonomy. Autonomy is freedom of action and freedom to make decisions. Divisional managers should be free to make their own decisions. Autonomy should improve motivation of divisional managers. For example, when transfer prices have been decided, the managers of all divisions within the entity should be free to decide, one, whether to sell their output to other divisions, that is, do it internal transfers, or whether to sell them to external customers if an external market exists for the output. And two, whether to buy their goods from another division, that's talking about internal transfer, this is the buying division now, or whether to buy them from external suppliers if an external market exists. Acting in the best interest of the company, because we can't just be talking about the war between the two divisions, the selling and the buying. They must all work in the best interest of the company because the company's objective comes first before the divisional objectives. In addition, divisional managers should be expected to make decisions that are in the best interest of the company as a whole. Unfortunately, divisional managers often put the interests of their own division before the interests of the company as a whole, particularly if they are rewarded, for example, with an annual cash bonus on the basis of the profit or return on investment ROI achieved by the division. In certain circumstances, the personal objectives of divisional managers may be in conflict with the interests of the company as a whole. A division may take action that maximizes its own profit but reduces the profit of another division. As a result, the profit of the entity as a whole may also be reduced. So we are looking at the problems with transfer pricing. We are looking at external intermediate market. A system of transfer pricing should allow the divisional managers the freedom to make their own decision without having to be told by the head office what they must do. At the same time, the system should not encourage divisional managers to take decisions that do harm to the company. The main problems arise when there is an external market for the goods or services that one division transfers to another. When an external market exists for goods and services that are also transferred internally, the market might be called an external intermediate market. So the name for external market is external intermediate market. The selling division can sell its goods into this market instead of transferring them internally. Similarly, the buying division can buy its goods from other suppliers in this market instead of buying them internally from another division. Divisional managers will put the interests of their division before the interests of the company. When there is an external intermediate market, divisional managers will decide between internal transfers and using the external market in a way that maximizes the profit of their division. Market-based and cost-based transfer prices and transfer prices based on opportunity cost. That's a subheading. As a general rule, when an external intermediate market does not exist for transferred goods, the transfer price will be based on cost, just like the three examples we first did: marginal cost, full cost, or cost plus, because there is no external market. When an external intermediate market does exist for transferred goods, the transfer price will be based on the external market price. However, the situation is more complicated when, one, there is a limit to production capacity in the selling division, or two, there is a limit to sales demand in the external intermediate market. That further complicates the decisions. In these circumstances, we need to consider the opportunity cost for the selling division of transferring goods internally instead of selling them externally. Don't forget, in the analysis we have done in the past, we mentioned something about opportunity cost. That is, when you have to make two decisions, and when we get to relevant costing and decision making, you'll be learning more about the effect of opportunity cost. You have two decisions to make. You are considering the cost of each decision. You have been doing a particular line of business before that brings you monthly profit of 100,000. You have equipment that you use in doing that business. Then a new business opportunity shows up, and that new business opportunity will require you using the same equipment you were using for the previous business. If you want to calculate the profit from the new business, which is the prospective business you are looking into, you will look at the direct and indirect cost to that business. Then an additional cost will be added, which will be the opportunity cost of the business you are doing before, which you are likely to leave to switch for a new business. That opportunity cost is going to be the profit you were making in that business you want to abandon. It's going to be added to the cost of the new business to determine if there is an additional profit to make from the business. If by the time you had that profit you want to abandon to the direct and indirect cost of the new business opportunity, if there is no profit, then the business is not worth doing. Because if I were to leave what I'm doing before and start doing something new, will I be able to make more money than I'm making from what I've been doing before? That's the way the concept of opportunity cost comes from. Don't forget the definition we already know, the alternative forgone in order to do a thing. That's alternative, that 100,000 you want to abandon in order to do a new business that wants to show up is what we call opportunity cost. That profit must be treated as a cost included in the cost of the new business during your analysis period to know if there is still more profit. It will now show that yes, the new business prospect is better than the ones you are doing. So in those circumstances, we need to consider the opportunity cost for the selling division of transferring goods internally instead of selling them externally. So the opportunity cost of transfers. Okay, further explanation is done here. The selling division and the buying division have opportunity cost of transferring goods internally when there's an intermediate market, external market. One, for the selling division, the opportunity cost of transferring goods internally to another division might include a loss of contribution and profit from not being able to sell the goods externally in the intermediate market. Two, for the buying division, the opportunity cost of buying internally from another division is the price that it will have to pay for purchasing items from external suppliers in the intermediate market. The ideal transfer price is a price at which both the selling division and the buying division will want to do what is in the best interest of the company as a whole, because it is also in the best interest of their division. Ideal transfer price must therefore take opportunity cost into consideration. Must take opportunity. Let me highlight this. Ideal transfer price must therefore take opportunity cost into consideration. So identifying the ideal transfer price. In identifying the ideal transfer price, there are three scenarios that need to be considered when handling transfer pricing mechanism. One, when there is no spare capacity. That is, the capacity that the division has is there is no spare, meaning that they don't have any excess capacity when they compare what they are generating as output now to what the division is actually configured to generate as output. They are maximizing the entire capacity, no spare capacity. This simply means that the selling division is operating at full capacity and cannot increase output beyond what is produced and sold. The optimal transfer price here is marginal cost plus opportunity cost of making the transfer. Don't forget, the optimal transfer price is the marginal cost, the variable cost this time. When we get to relevant cost, you will be seeing the reason why we don't consider fixed costs when decisions want to be made. It is as simple as fixed costs will be incurred anyway, whichever decision we make. Fixed is fixed. If you rent a shop and you are selling inside the shop, you are selling a particular product and somebody is introducing a new product to you. If you want to calculate the profit from the new product, you don't need to be including the rent of the shop, because whether you had the new product or the one you are selling before, you will still pay for your shop rent anyway. It's fixed. So in decision making, you don't consider fixed costs. It is the marginal cost of that new product that you have to put into consideration. And don't forget, the difference between sales and marginal cost is contribution. That is why in decision making, we use the contribution to make decision. So when we are saying there is no spare capacity, we will only consider the marginal cost plus opportunity cost of making the transfer. When there is spare capacity, this is when the selling division is not operating at full capacity. The transfer price is the marginal cost of producing the transferred item when they have spare capacity. So this is when the selling division is not operating at full capacity. You will not include opportunity cost under these circumstances. So when you see question, we'll be treating this one on Thursday because time is not on our side now. We have examples on this. When in question, read very carefully to know whether the division that is selling internally has spare capacity or whether there is no spare capacity. If there is no spare capacity, add the opportunity cost. But if there is spare capacity, there is no need to abandon what they were selling before. For instance, the capacity of the selling division is 1,500 units. But currently what they are producing is 1,000 units. Now division B, which is the buying division, needs 500. It means that they can increase their capacity without affecting what they are supplying to external market, which is 1,000 units. They can sell 500 and still not lose the profit they are making from the previous sales. So they have spare capacity. Therefore, it is only the marginal cost. We are not going to include fixed costs. That's not done at all. And the opportunity cost will not be done because we are not abandoning anything. There's no alternative for gone here. Third, when there is a limited spare capacity. This is a variant of B above. That is the variant of this second option. Under this scenario, the selling division needs to beef up additional product from external suppliers to meet the limited requirement for the buyer. The optional transfer price is computed as say in the same mode as B above, that is the second one above. The transfer price for the unit met from the spare capacity is at marginal cost, while that of the remaining is at the opportunity cost based on the purchases from external supplier. Okay, this my system wants to shut down in just 4 minutes. Let's call it a date now. On Thursday, by God's grace, we will start from this place and then we move forward to